Good morning, everybody. It's Dan Kautz.
Good morning, Jeff Buckley.
And here we are for our April webinar that we're putting out. It's been a hell of a month, hasn't it?
Yes.
Oh my gosh. We got to do a little housekeeping here as usual. And I think you're going to be, some of you guys out there are going to notice that we have upgraded our process here. Instead of sitting at the side, shoulder to shoulder at that table and putting out the webinar, we've now dedicated one of the rooms to a webinar or a Zoom room. And I got to get used to some of the technology.
Yeah.
So give me a second if I miss on putting the slide forward when I should and back. So give me a little chance on that one. I feel like a little bit of a weatherman here. So let's get into it. This is a quick check-in, and these started back in the pandemic days.
That's right.
And doesn't it feel like
way.
we're full circle with the market? But this webinar will be recorded. It will be posted to our website a little later this week. We cannot accept live calls or chats during the webinar. Our contact information is dkautz@kautzbuckley.com, jbuckley@kautzbuckley.com. Our office our office number is 716-276-8480, and the ever so popular office text line 716-272-1129. So as we said, it's been a hell of a week, and Jeff, you and I have been talking about these slides as we put them together, and how it just changed so quickly.
Right. Yeah. So we'll get into that. I mean, it's things are changing very rapidly, and we're just only a week and a half into April so far, and it's been quite a month.
And I can remember we were working on these earlier this week, and as we were putting them together, holy cow, right around lunchtime, we had a U-turn.
Yes.
So some of the information, it's good information, and it's a nice benchmark.
Right.
But things are moving quick. So Jeff, why don't you take it away? And we got the same format as we always do, just a couple different graphics.
Yeah, and to begin with, as we try to do every month, we think it's always helpful to take a look at kind of where we've been. So before we get into the craziness of April, let's take a look back at March, and then really not only March, but really the whole first quarter of the year. So we've got a quick update here. And what this really shows you is the first quarter, not that great. We started out the year, if we kind of look over at this part of the chart here, in January, and really all of the indices that certainly that you hear about on the news at night, the S&P 500, the Dow Jones Industrial, the NASDAQ, and then some of the ones you might not be quite as familiar with, but are certainly very important, the Russell 2000, that focuses on a lot of the smaller companies in our economy. January was a pretty good month, across the board greens, but in February, about halfway through the month, things started to fall apart a little bit, and it was particularly hard on some of the smaller companies and the large cap tech. So the Magnificent Seven, large cap, it just means the biggest of the big, the companies like Apple that are just phenomenally large. They did not have a good February. There was a lot of concern about the high technology sector, and so as a result, people started pulling money out of there. And what we had been seeing a little bit of that in the year prior, and really the whole quarter prior, but they weren't necessarily pushing that money into stocks in other sectors. Instead, they were just looking maybe for the safety of bonds, that kind of thing. And March ended up being a particularly bad month as well. So when we really look at the entire quarter, even factoring in those positive returns in January, the quarter itself was down. And if you look, the biggest loser of all was that Magnificent Seven. That's your Apple, Microsoft, Google, Facebook, Meta, NVIDIA, the stocks that everybody's talking about, honestly. So it was a little bit difficult, and then we look even back into December too, how it compared in the 52-week highs. I mean, we're down in those high large cap, high growth tech companies. We're down almost 22% versus where they were at their 52-week highs. So again, we started out difficult. There's a couple of headlines over there. We had a lot of economic, geopolitical, and financial market uncertainties. They remained elevated. And we also knew too, especially beginning in March, We knew these tariffs were coming from President Trump. He was talking about them, and we were getting closer and closer to his Liberation Day, as he called it, April 2nd. So that seems to be why, as we progressed through that quarter, things just got a little bit tight. So,
so much more to be said.
Yeah. Well, that gives us a little bit of perspective there. The next slide really just shows individual sectors too. Just because we feel it's helpful to look at these things, because if you're looking in, at energy, the top line there, energy is considered something of a defensive sector because they generate consistent income. A lot of it is government regulated. So they're able to spin off a consistent source of income and dividends to their shareholders. So being defensive, you can see January, February, as things got a little dicier in the markets over the first quarter, they were up significantly, but most of that came in the last 2 months of the quarter as people got more defensive. And then compare that all the way down to, technology and discretionary stocks. Those were the two hardest hit, really.
Right, discretionary is what people are willing to spend their money on.
Yes.
This is,
not essentials necessarily.
Really, when we look at numbers going forward, when we get this speedometer, it's really that the people didn't have the money.
Right.
It's people didn't want to spend the money.
Yeah.
So, all right.
That's it. So you can jump to the next slide there because
hey, easier said than done.
That's right. You're getting it down.
I am.
Well.
I'm pretty pleased with myself so far.
But this is always our kind of our quick snapshot. So we took a little bit of a look in the rearview mirror, and now what we're doing is looking where things were. And here's where, as Dan started out saying, this is where things got crazy for us, okay? If you look and see, and we've told everybody this for compliance purposes, we need to prepare these slides a little bit in advance so they can be reviewed by our compliance department and approved before we can record our webinar. The way April has been moving, it just changes almost on an hourly basis since April 2nd. After the market closed, that's when President Trump announced the tariffs. So this is as of April 9th. And honestly, these would be the returns through April 8th, actually, the close. This data was taken on April 9th from the returns on April 8th. And if you recall, we started out on the 3rd and the 4th, which was a Thursday and a Friday. Those days were extremely difficult. We went through the weekend. There was no development on trade negotiations to resolve the tariffs. So we hit Monday and Tuesday, and those were difficult days as well. And I think that's reflected in here. But these numbers are showing if you had a portfolio on the more aggressive side, about an 80% allocation to stocks, 20% to bonds, your return year to date has dropped to almost 9% negative. And again, it was such a significant drop those first couple days that it actually had an impact even on your total 12-month returns and even going back a 3-year. If you recall last month, these numbers were significantly positive. Yes, they're still positive here, but difficult. So that was it. Now, on the 9th is the day, let's see, today, we're working through the days. It's been that quick. And again, maybe this is a good time for Dan and I to kind of stress to what we try to talk to our clients about, and remind everybody that these markets nowadays are moving so quickly and we have such a short news cycle that to get out of the market, you're running the risk of missing significant
Key
rebounds.
Days.
Yes.
It's what we did say when we were talking to the clients last Friday when this was all unfolding. We kept saying, hang in there, because when this turns, it's going to turn fast. It's exactly what happened on Wednesday.
Yeah, and that was those were historic levels in the market, as historic rebounds there. Again, this chart is a little dated. It does not include the market rebound that we did see, which again, I think with the NASDAQ alone, it was up, which would be, it's probably going to fall more in this area because the NASDAQ is a very
it's
tech
more of a
focused,
tech focus, more of the equity side. Yeah. But I think what this chart also shows is the reality of what Liberation Day brought to us. And if you can take a look at when you're in a less riskier portfolio, more bonds, and then equities. Here we are, 30% equities, 70% bonds, 20% equities, 80% bonds. Remember, when the bank comes knocking, you got to pay them. And what that means is when you own bonds, you're the bank. And who owned the most bonds, United States bonds? China and Japan.
Yeah.
And when you saw what happened was these bond returns started going negative because at the, Tuesday night, came some news that China decided to unleash some of our U.S. debt. And I think that was a moment of holy cow and led to a Wednesday morning, we should talk about this. And some cooler heads prevailed, and it looks like we're on our way where we need to be going. So do you want to go back to that?
No. I was just going to say to kind of shift now and say, okay, we've had the tariffs imposed. We've now had a 90-day moratorium announced. We've supposedly got about, 75, 80 countries. I think that's the latest news from the White House that want to come to the negotiating table and come to an issue. So the tariffs on those countries have been postponed 90 days. We got a market rebound based on that, but we've only recovered about half of what we were originally down on the announcement of the tariffs. So, and we also 90 days is 90 days. We don't know what's going to happen during that time. So this is our speedometers. This comes from one of the money managers we work with very closely, the City National Rockdale. And again, those of you that tune in monthly to our webinar here, we had been seeing a lot more green. And now to kind of move this forward, these speedometers, I think, were modified after because we had to struggle to get these out of City National Rockdale.
They were modified prior to the turnaround on Wednesday, is what you're saying.
Yes, right. That's it.
So some of this
after the announcement.
After the announcement, actually, dated news possibly. You know? But let's take a walk. Let's walk through them because some of them are very significant and indicates exactly where we were heading and why it was important to turn the car around.
Right.
So
I mean, like economic outlook, and you can see the gray area is where that needle had been last month, and you can see that's fallen significantly. There was significant concern that as the longer these tariffs stay in place, that we could be pitched into a recession here. So consumer spending. So it's only 2 green on here. Credit demand and availability is still positive, and pretty significantly so. And fiscal policy. We'll see where that goes. That's more the policy coming from the Federal Reserve. There's still a lot of thoughts that inflation is still somewhat under control, and so the Federal Reserve may be more in a rate cutting stance than a rate hiking stance, which is certainly favorable to the market.
And I want to stress too, that a lot of this information is lagging information. In other words, it's after the fact. The only true real forward indicator is the market. And right now, as we saw, the market was on a free fall. It's turned around pretty quickly. We should be able to move forward from this point. But these are important indicators. But as we've said, it moves quickly right now. You can just see it. I think it's self-explanatory. We could talk hours on this, but let's move on. Here we go. Moving on to the next slide. We want to talk about our perspective on how things are going and where we're going. What do you think here, Joe?
Well, and again, it seems almost like an eternity ago at this point, but really was just the April 2nd after the market closed is when the tariffs were announced. So, the general consensus is the reason why it had such a detrimental effect on the markets is that tariffs were announced. Yes, okay, we all knew that was coming. It had been telegraphed for months. However, they were much steeper than expected against our trading partners. And then we started to see almost immediately after that some retaliatory tariffs coming in from China. There was something of a response from Europe, which certainly 2 of the U.S.'s largest trading partners. Right. So that's really seems to be what spooked it. And honestly, here it is. It was one of the steepest 2-day financial markets lost in all of history. And that includes the financial crisis of 2008. That includes COVID, that kind of thing. It's up in that echelon there. So it's difficult.
This is a pretty drastic. The entire world economic order is being shifted. I think that was a pretty true statement on Liberation Day, but I feel as if that has been backed off a little bit now, at least for 90 days.
So we'll see, yeah. So, what we're doing, what we're talking to our clients about. In this first one, Dan and I, honestly, we kind of discussed whether we wanted to necessarily even focus on this.
On there.
But this is something, and I think in fairness to the money managers we work with, this isn't a response within the last couple days. This was a response as we got closer to Trump's announcement of tariffs. The money managers were saying, listen, maybe increasing our cash position by a little bit, not huge amounts.
1%.
Yeah, exactly.
Maybe.
Keep a little bit there. They're still earning a decent rate of return on cash that's held in portfolios. Keep a little powder dry, see what the markets do, and go from there.
That's the key. On the raising the cash, I was talking with one of the money managers the other day, and before the turnaround, we were going to a position of thinking about we're going to have to raise some cash because this is going towards recession. We're in a bad position.
Yeah.
But when we started talking, and the U-turn came on Wednesday, but prior to that too, we had some portfolios that were sitting on some cash, and I kept saying, "You're telling me one thing, but I'm seeing cash on another." He said, "Buying opportunity's coming.
Yeah.
It's coming." So we just want to make sure we're in the correct spot to do the buying opportunity on the way up. So raising the cash that you might see in your portfolio isn't a defensive move. Right now, it's keeping the powder dry.
Right.
And for 90 days and for the few next days is going to be some buying opportunities. And there's no doubt that we went to tax loss harvesting. This is when you work in non-qualified portfolios other than IRAs. And this is where you can sell off some of your losers or gains, some of your big gains or losers in there, and lock in some of those tax losses. And we have some portfolios that will be having tax losses locked in that when we rebuy with the cash that's on the sidelines and that money goes up, we have a gain in those. We're going to have a capital loss to offset against the capital gains, making that gain in your portfolio offset or tax neutral, shall we call it, okay? So that was a huge opportunity we had within this market, and we executed on that well, I feel.
Yeah, and then just a reallocation too. For decades, really, international markets had almost exclusively had been underperforming the U.S. markets. We've now seen something of a shift there, and our money managers that we work with are starting to move our clients' portfolios to get some exposure to European markets, to developed Asian markets, that kind of thing. So they're chasing some return here, which is very positive, but it's becoming easier to do outside of the United States. So we're seeing that shifting exposure kind of from some growth-oriented stocks to maybe some more income-generating stocks, like you're switching out your Microsoft for a Procter & Gamble to get that dividend income coming in and that stability that a company like Procter & Gamble offers. I think just to kind of sum this up, though, one of the things that Dan and I like to remind everybody is your portfolios are being actively managed, okay? If you're with AssetMark, we've got one of the money managers we're working with, or possibly multiple money managers, we're not just sitting on our hands. This isn't a buy and set and forget portfolios. These are being actively managed, and they're responding to the market conditions on a daily basis, really. So,
All right.
Yes. So again, how we're advising our clients, this is really, just kind of reminders. I guess I jumped the gun a little bit there, but this is it. I mean, your portfolio is tailored to you. It's not going to be the same as our next client, Everybody has a portfolio that's tailored to your individual investment needs, your goals, time to retirement, risk tolerance, your income needs. These are all very important things, and they're going to be a little bit different for everybody. It is actively managed, so we're responding to these market fluctuations and the volatility. And just a reminder, because we're not done with these tariffs yet, they're still out there. They can influence market conditions, but again, it's generally not a good idea to make your drastic changes on your investment strategy based on short-term policy shifts. And I think really the last week is a perfect example. Yeah.
And the other reason why I really enjoy using third-party money management, it takes the emotion off. Because when a client calls and they're on the ledge, we get the phone call, we hear your emotion, we hear the angst in your voice. And it's nice to take a beat before a decision's made, and it's not made emotionally. In this situation, proved
Paid
it.
off, right?
Absolutely, and it's not the only time. This has happened many a times that you can't get emotional about the money, but it's really tough when it's the money that pays for the vacation and the food, isn't it?
That's right.
So
that's right.
it is tough.
Yeah.
But
I was just going to say this last slide, this is really just, I threw this in at the very end just kind of to wrap things up as a little bit of an example. Now, I don't know that we have any of our clients, quite frankly, that own this particular mutual fund. The reason why I picked it, though, is number one, it's from American Funds. That's a well-known company whether you might have some American fund investments or not, you've certainly heard of American Funds. This is one of their target date retirement funds. And the reason why I picked this fund is because these funds, by their very nature, give you an asset allocation between stocks and bonds, and then when you're on the stock side, between international stocks, large companies, mid-sized, small companies. It's a very good allocation, and it's about a 60-40 portfolio, about 60% exposure to stocks, 40% to bonds. So I'm just using this as kind of a snapshot, a barometer to show you maybe what's happened in the markets. Now, here it is, the price at the close of markets on Wednesday. Remember, the tariffs were announced after the market closed on April 2nd. This mutual fund was trading at $19.11 a share. Now, 2 days at the close of the market, 2 days later, that Friday, April 4th, it had dropped to $17.94 a share, a loss of 6.14% in 2 days, okay? But I went back and I looked historically how this fund had been performing. And if you look just almost a year ago, okay, roughly give or take a month there, April 30th of 2024, that stock was also trading at $17.99 a share. Okay.
Mutual fund.
Or the mutual fund was, yes, where it was at the close on April 4th, about 1 year prior. But if you keep moving forward during that 2024 calendar year, a little more than 2 months later, on July 10th, 2024, this same mutual fund closed at $19.19 a share, actually a little bit higher than where we were on April 2nd. So it shows you just within the span of a year, we've had these exact same fluctuations. Right. It didn't happen in 5 days or 2 days, right, but it certainly continues. And that's why being in the markets, time in the markets instead of trying to time the markets.
Don't let me talk over you. Mention it one more time because that's very important.
Yeah, just the time in the markets, not trying to time the markets.
That's so true.
Yes.
And as we said, hang in there in these times. There's a lot of commentaries out there will tell you the market's made on 7 days. I'll tell you, what day? Wednesday.
Yeah.
Wednesday was one of those 7 days. Listen, I want to thank everybody, not only for just tuning in and listening to us as we go through this stuff, but also for the fact that you hung in there, you have your faith and your confidence that you share with us, that we can guide you and your family through these times. So please remember, we're here. Give us a call. Let us know what's going on, and we'll be there for you, all right? But I want to thank you all very much. Have a great week.
Thank you.